Happy Friday, everyone. So we got a few people missing. I know a lot of we got some students missing because of the Beta Alpha Psi National Conference. I want to propose something to you all right? So a few years ago, we had actually a lot of students that were missing. Big substantial portion of the classes, like 30 students in the class, and like six of them are missing for a conference for a different student organization. I'm not going to mention the name of the organization. Their initials are DSP. But I said at the time, I said, it's not fair that we have to be here in class, doing homework and they get to actually have fun at a conference. So I promoted, I said, points in the class are a commodity. All right. The points in the class are commodity. And if they don't want their points, then we should be able to allocate that out to the rest of the students in the class, which I thought was only fair. And so all the students that agreed. And as it turned out, these students, again, in the unknown, unnamed organization that I'm not going to talk about, they did not respond to me and say that they were opposed to this. All right. So here's what I propose to you. Okay. Let's agree all as a class. Okay. All as a class that these students that are at the Beta Alpha Psi conference, that unless somebody of this group opposes that they do not want to have their points allocated, that we take their commodity of points and we allocate it to everybody here in the room. Does everybody agreement with that? Okay. Now, again, I'm going to give them fair opportunity. All they have to do is watch the video and the review video, and they have to say, no, Dr. Barnes, I'm not okay with this. But if I don't get any messages like that, I'm going to assume that they're completely and totally fine with us giving out points to everybody in the class. All right. So free points for everyone. Okay. I might even take a few of myself. You never know, It's good to be king. Yeah. Yeah. So quick note about a couple of things coming up in the next few weeks. There were some questions, and I guess I didn't explain it well enough, and that's my bad. But for the discussions, we do have a few more discussions coming up. Two more before the exam, and then one more before one more after the exam. For the discussion assignments, they're listed as assignments on Brightspace, just to remind you that they're coming up, but there's no actual deliverable associated with them. That being said, I do expect you to prepare. Now, for next week, next Wednesday, we do have a discussion, quote unquote, activity. It's actually not as much, it's still much discussion as activity. You need to do zero preparation for that one. You just need to come up and be prepared, okay? And prepared for what? Just be prepared for anything, okay? That's all I can tell you. Then Friday, or sorry, the week 4, which is going to be chapter 5, we do have a discussion. Everybody in the class has been assigned to a particular topic in that discussion. So just take a look at the list of items that are in the discussion and be prepared to talk about that. The details that you need to be prepared for are listed out. It's pretty straightforward. But when I call your name in that discussion, I expect you to be able to provide the details that I'm asking for, and we'll talk about what the necessary details are when we get to that chapter. That's basically what I'm looking for, is being prepared to discuss the items that are listed in the discussion topics and go into detail in depth on those. Chapter 6 is a little bit different. Chapter 6 will actually be a problem over a case that we're going to discuss in chapter 4, but we're going to reflect back on it from the controls perspective. Everybody cool with that? All right. Stuff that you do have to turn in is today's assignment, homework. So let's go ahead and get started on reviewing what we have for homework today. So question 317, before accepting an audit engagement, a successor auditor should make specific inquiries of the predecessor auditor regarding the predecessors. Now, let's just clarify the terminology here so there's no confusion, all right? I'm going to be the auditor that's taking over the new engagement. Does that make me the successor auditor or predecessor auditor? I'm a successor, okay? So make sure that we have that clarification terminology. Predecessor auditor is the person who actually did the engagement previously. I'm going to reach out to them and try to gain some information from them. So what is some information that I'm going to get? So let's just go ahead and go through the answers. Awareness of the consistency application of accounting principles between periods. Is that something that we specifically talked about that we have to do with the predecessor auditor? No, okay. Is that information they could volunteer? Sure, okay, but that's a little bit specific. That's a specific information that's being applicable. And even then, the predecessor auditor probably wouldn't have that information. Evaluation of all matters of continuing accounting significance. You like that word absolute? What did we say about absolutes last time we went a homework review? Never use absolutes. Never. All right. Never. All right. Opinion of any subsequent events occurring since the predecessor auditor's report was issued. Keep in mind, we will talk about subsequent events, but it's important to note that we're not responsible for subsequent events after the financial statements issuance. Okay. So subsequent events are kind of a bright, not a bright line criteria, but for the most part, the predecessor auditor would not be responsible for that. So we'd have to see. Besides, none of the top 30 ones are things that we talked about. Something we did talk about specifically is understanding as the reason for the change of auditors. All right. We need to make sure the predecessor auditors a clear understanding of why they are no longer the auditor and now we are the auditor. And that needs to be communicated. So D is our answer. Question 18. A written understanding between the auditor and the entity concerning the auditor's responsibility for fraud is usually set forth in the, what is the name of that document? The engagement letter. Yeah, that's the contract between the two parties, the engagement letter. Just for context, I told you there are 3 sections of the engagement letter that I wanted you to remember. And I said this is one of the examples of things that is not in this slides, but you should write down and make notes of it. Does everybody remember those 3 sections? Raise your hand if you remember the 3 sections. All right, I didn't think so. All right, so let's talk about that real quick. Remember, the objective of the audit, okay? Manager's responsibility and auditor's responsibility, okay? Those are 3 sections that are always in every engagement letter. There's multiple sections that can also be included, but in every single engagement letter, those 3 parts will always be present. So objective of the audit, manager's responsibility, auditor's responsibility. Also, we've talked about it to a limited degree, but let's make sure we're clear on manager's responsibility and auditor's responsibility. So who's responsible for the preparation and presentation of the financial statements, management or auditor? Management. Who's responsible for the design, implementation, maintenance of internal control? Management. Okay. Who's responsible for testing the financial statements to make sure that they're reasonable or they have reasonable assurance the financial statements are free from material misstatement? Auditor. Who's responsible for testing and understanding internal controls to make sure that they're operating, designed and operating effectively? That's the auditor. Good. Okay. Remember the distinction. They're related, but manager is responsible for the creation of those items. Auditor is responsible for the testing of those items. Is a way to delineate those. All right. Question 319. If the independent auditors decide it is efficient to consider how the work performed by the internal auditors may affect the nature, timing, and extent of audit procedures, they should assess the internal auditors what? So we talked about 3 criteria, okay? 2 of these criteria are present, okay? So what were the first 2 criteria we talked about? Competence and objectivity, okay? Those are 2 that are listed, that's A. What was the 3rd one, by the way? Does anybody remember? Yeah, systematic and disciplined approach. Yeah, systematic and disciplined approach. Now, what is that saying? It's saying that if we want to utilize the work from the internal auditor, we have to evaluate all 3 criteria: objectivity, competence, systematic, and disciplined approach. Why? The goal here is we want to reduce our work as the external auditor. And if we can rely on the work that the internal auditor is performing, that will reduce our work. But we have to make sure that's good. They do a good job. Have to make sure they're objective, that they're free from any entanglements. They're competent, they know what they're doing, and they use a systematic and disciplined approach, that what they're doing makes sense. That's effectively what we're doing in that scenario. All right. During the initial planning phase of audit, a CPA most likely would do what? So these are questions that will pop up pretty continuously throughout our homework throughout this course. These actually have to do with what phase of the audit we are in. Now, the good news for this particular question is we've only discussed 1 phase of the audit so far in this course, and that's the planning phase, all right? This will become extremely pronounced once we start getting to later parts of the semester when we start asking about different phases of the audit. But for right now, we're just in planning, all right? So let's go through each answer. Identify specific internal control activities that are likely to prevent fraud. Have we got to the point where we're going to be looking at specific internal control activities? No, that's probably at earliest going to be risk assessment, but more likely going to be test of controls. Evaluate the reasonableness of the entity's accounting estimates. In planning, are we actually looking at any numbers yet? No, so we can't really evaluate the reasonableness of estimates. Discuss the timing of audit procedures with the entity's management. That sound like something you do when you're making a plan? Sure does, and it's probably our answer. But let's go to D. Inquiry of the entity's attorneys if it's probable that any unrecorded claims will be asserted. So this is going to be something that we'll do at the very end of the audit. We're going to talk to the attorney and say, hey, here's some information. Can you tell us whether it's accurate or not? It's going to be part of a legal letter. We don't need to worry about that now, but we will talk about that before exam number 2. All right, so C is our answer. It's fun, guys. Wouldn't you rather be doing this than anything else on a Friday afternoon? Yeah. As generally conceived, the audit committee of a publicly held company should be made up of what? So we talked about 2 criteria with respect to the audit committee, okay? First criteria is outside independent board members. What does that generally mean when we talk about outside independent? They can't be members of what? Management. They can't be members of the company's management. They're not outside independent if they are, okay? What is the second criteria? Does anybody remember? Yeah, have to have a financial expert. How many people on the audit committee have to be a financial expert? One financial expert. Okay. So which of those actually aligns with the answers? So if we look at D, members of the board of directors who are not officers or employees, that's going to be our best representative of outside independent board members. So D is our answer. All right. When planning an audit, another planning question, auditors should do what? All right, let's go ahead and walk through the answers again. Consider whether the extent of substantive procedures may be reduced on the results of test of controls. We don't even know what that means yet because we're not that part of the course. That will make a lot more sense once we get to risk assessment and once we get to actually looking at substantive procedures and test of controls. Trust me when I say this is an important step, but it's something that's going to occur later. Okay, we're not in planning phase yet. Determine overall materiality for audit purposes. Have you all done that? You have, so that sure sounds like something we do to planning. So B is probably our answer. Conclude whether changes in compliance with the prescribed internal controls justify reliance on them. What do we have to do in order to understand the justified reliance on internal controls? We have to know what the controls are. We're not to that point yet, so we can't do that. Evaluate detected misstatements. Now, this is something I alluded to on Wednesday. When we determine materiality, that's basically our assessment, our plan for the rest of the audit. We are going to compare that to the results of our test at the end of the audit. But in order to be able to have that information, we need to actually perform test work. We don't determine what those misstatements are until we actually perform that testing. So this would occur at the end of the audit. So the only one that makes sense is going to be B. All right, question 325, tolerable misstatement, tolerable misstatement. So what do we say about tolerable misstatement? Is that at the financial statement level or the accounting disclosure level? The accounting disclosure level, okay? So what are we trying to say with accounting disclosure level? So when we say materiality used to establish a scope for audit procedures for the individual account balances or disclosures, you guys think that sounds appropriate for tolerable misstatement? So in fact, what you did as part of the Earthware Clothiers materiality workbook, you actually assigned tolerable misstatement to each account, which we're going to get to. We're going to get to in just a second. All right. Which of the following would an auditor most likely use in determining overall materiality when planning the audit? So we're talking about a quantitative basis for determining overall materiality. So this is going to be some account that we'll use a percentage of. Let's go ahead and go through the answers. The anticipated sample size of planned substantive testing, that actually is not relevant. Sample size will actually be derived once we've determined materiality, and we'll get into that more when we talk about sampling a little bit later in the course. The entity's income before taxes for the period to date, which would be like 6 months. Does that sound like something we've talked about? That was one of our quantitative bases. So it's probably B. The results of test of controls? Nope. We do this before we ever test controls, so that's not correct. The contents of the engagement letter. Did we actually mention anything with respect to materiality with respect to the engagement letter? We did not. That was one of those things that was notoriously absent. This is an important point to make, by the way. We as auditors establish what our assessments of materiality, and when we talk next week, we're also going to talk about audit risk. We actually establish those independently of the client. The client has no input as to what materiality is or what we assess as audit risk, okay? These are determined by the auditor, okay? So when we talk about the assessment of those, you may see questions that pop up and say, the client has information that relates to this and the client's going to help the assessment. Client doesn't do anything with respect to that. They'll provide information, but they don't have any input. There's not part of their judgment. It's the auditor's judgment for materiality and audit risk. All right. Let's move forward. Question number 333, discussion question number 3, or problem number 333. There we go. For each of the following scenarios, perform the 3 steps of the materiality process. Determine overall materiality, determine tolerable misstatement, and evaluate the audit findings. Now, this is interesting because it doesn't give us a lot of guidelines. So we are going to have to provide some simplification here. So let's just go ahead and let's make this easy. Now, if you use different criteria, that's fine, okay? If you use different criteria, that's fine. But I want to simplify this for our purposes, all right? We're going to first of all make our determination of overall materiality. Then we're actually going to set maximum tolerable misstatement, which it doesn't really specify that. It says determine tolerable misstatement. We don't know that because we really don't know what the nature of the accounts are. So we're going to actually say when it says determine tolerable misstatement, more specifically, we want to know maximum tolerable misstatement. I'm going to use a very simple number. I'm going to say 50% of planning materiality. Why? Because 50% is a lot easier to calculate than 75%. It's just easy to cut things in half. All right. If you used a different number, that's totally fine. There's no wrong answers to this. It's all subjective. Actually, there are some wrong answers, but for the most part, there's not a wrong answer if you use 75% or 50%. All right. Then we're going to evaluate the audit findings. Now, scenario 1 is pretty straightforward. Scenario 1 is pretty straightforward. Got Murphy and Johnson, a privately owned manufacturer of small motors for lawnmowers, tractors, and snowmobiles. The components of the financial statements are listed there. Okay. So determine overall materiality. Now, what is our standard basis? What is our general guideline for overall materiality? What account do we use? Income before tax, pre-tax income. Okay. And what was our percentage for that? 5%. Okay. Would that be appropriate in this scenario? This is a profit-oriented entity. They're private, but yeah, they're profit-oriented. So yeah, we're pretty good at that. So we're gonna say 21 million would be our appropriate amount. So sorry, 21 million to be appropriate basis. I'm gonna pull out the calculator here because I don't trust myself to find the right numbers in my answers. All right. So 21 million times 0.05, 1,050,000. Everybody happy with that for overall materiality? Okay. So then we're going to assign a maximum tolerable misstatement. What I say, it was going to be 50% of this. So I'm going to multiply this times 0.5. So 525,000 for tolerable misstatement. Now let's just go ahead and reiterate what this means, okay? Planning materiality is going to be the amount that the financial statements as a whole can be misstated and still be okay, all right? This is basically saying the most that we can assign to any one account for tolerable misstatement is 525,000. This is not saying every single account will have a maximum misstatement of 525,000. This is the most, this is the ceiling. Most of our accounts are going to be much lower than this. All right. We're going to assign some amount, some arbitrary amount below that, depending on the nature of the account. I shouldn't say arbitrary because that assumes randomness, but we're going to assign some amount loaded in that based on the characteristics of the account. All right. So during the course of the audit, Murphy and Johnson CPA firm detected 2 misstatements that aggregated to an overstatement of 1.25 million. Evaluate the audit findings and justify your decision. All right. So what do you guys think? Are you guys okay with this, or is there a problem? There's a problem. There's a problem here. So we said our planning materiality was 1.05 million. This is saying after they did their testing, they found misstatements that in total equaled 1.25 million. This is greater than our planning materiality. In other words, the amount of misstatements exceed our materiality, what we can accept. All right. So we're going to go to the client and say, here's the deal. You've got misstatements that are greater than planning materiality. You're going to have to make adjustments to the financial statements. What if the client makes the adjustments? Are we okay with that? Yeah, we're good. If they make adjustments to their financial statements for those 2 accounts, we're going to be like, all right, great. You can sign off on the audit and we can go sip some margaritas and Mikasa. I don't know, whatever. Okay. We can go relax. All right. Go enjoy ourselves. What if they don't make the adjustment? What if they say, well, we're not going to make any adjustments to our financials? Yeah, we're going to issue a bad opinion, probably a qualified or an adverse opinion, because their financial statements are materially misstated according to our audit. So that's what we're coming to conclusion here. All right. Delta Investments provides a group of mutual fund for investors. The components of financial statements, they're listed there. Okay. Determine overall materiality. Now, we've already, oh, sorry, go ahead, Jack.
I'm confused on the difference between the tolerable misstatement that was the 50% of the total versus the 4 times. Like, what's the name of that? Because that's what I thought the tolerable misstatement was called.
So tolerable misstatement, as we talk about it, maximum tolerable misstatement is the amount for one single account. What you're referring to, the 3 to 4 times, that's aggregate tolerable misstatement. So it's adding all of the numbers together that we assign for tolerable misstatement, which we will do when we get to the materiality workbook a little bit later.
So it's just called aggregated tolerable.
Yeah, exactly. Yeah, good question. All right, so we got some mutual fund groups components that are listed. What do you guys think? Can we still use pre-tax income 5%? What do you guys think? Probably not. What's the reason why we do not want to use pre-tax income of 1%? It's an asset-based entity. Look at the deviation between their income and their assets. Income is 40 million. Total assets are 4.3 billion. Okay. So that's a pretty substantial difference between those sides of those 2 accounts. So even if we use to just really, sorry, income before taxes is less than 1% of total assets. Okay. So that's one of the big issues we're talking about. So we're probably going to be talking about using some percentage that's going to be lower. I'm going to see what I've got in my solution here. So let's go ahead and we'll just use context. Let's actually look at a couple of issues. So let's assume that we used income before taxes. All right. Now we've already established that's not the case, but I want to use this for context. All right. $40 million times 0.05 means $2 million is our overall materiality. Everybody got that one right there? Okay. Let's go ahead and now say that I'm going to use assets. And I'm going to use a very small amount. I'm going to say 0.05%, 0.5% times 4.3 billion. Make sure I get all the zeros here. That's 21.5 million. Now you're an auditor. You have a choice. You have overall materiality of 2 million or overall materiality of 21.5 million. Which one are you going to choose? 21.5 million. This is a lot less work involved associated with this because you can accept much larger misstatements. All right. $2 million is very, very small. So let's go ahead and accept that. And then that means maximum tolerable misstatement is going to be. Oops, is that right? Nope, I did. I messed something up. Oh, it's 7.5. Yeah, that's easy to fix. I can multiply times 10 because I know math. All right. So roughly $11 million, a little bit less than that. All right. So we've got planning materiality of 21.5 million. We've got tolerable misstatement of 10.75 million. So some really large dollar amounts. It looks like they had two misstatements that in aggregate in total, the over misstatement of income is 5.75 million. So these are the actual detected misstatements. How do you feel about this as an auditor? It's like I'm heading to Mikasa for a margarita. That's how you feel. Okay. You're done. You're just kind of like, this is not material. I'm moving on with my life. Okay. All right. Does everybody see why there was such an important difference? Why we use 21.5 million versus 2 million? Because if it was 2 million, you're just kind of like ripping out your hair, and I don't have that much hair left to rip out. Okay, so you can't really do that for me. So you're gonna have to want to use a larger amount so we can actually say that this is fine. All right. This one's a really bit tricky one. This one's an interesting and tricky one. Okay, let's talk a little bit about this. All right. So Swell Computers is a public company that manufactures desktop and laptop computers. The components of the financial statements are listed here. All right. So before I look at the numbers, what would be my natural inclination to use as my basis for materiality? Pre-tax income. Okay, pre-tax income of 5%. Is there any reason that people might want to say that we use something different here? Well, look at their income before taxes. It's $500,000, and that's based on assets of 2.2 billion and revenues of 7 billion. Okay, so it looks like that they barely broke even this year, which actually has some interesting implications that we'll talk about here in just a second. But if I used pre-tax income, 5% of 500,000 is $25,000. Does anybody want to do audit testing with $25,000 as materiality? That's that absolute assurance that we're getting in right there. That's like the entire semester's worth. Like your entire busy season is just doing testing. That's all there is to it. Yeah, that's way too small. So we're going to use total assets. Okay, we'll just use the same basis we said for total assets. So 2.2 billion times 0.05. So $11 million is our overall materiality. Now, again, 11 million versus 25,000, that's a much bigger distinction right there. Okay. 25,000, you never leave the office, $11 million, things are probably fine. But there's a little bit of a caveat here. We've got some concerns. All right. We'll get into that in just a second. So maximum tolerable statement is going to be half that. So multiply that times 0.5, 5.5 million. And it looks like that they have overstatement of income by 1.5 million. Now, all other things being equal, ignoring information that some of the information that's really prominent here, are we concerned about a $1.5 million misstatement? Not really, okay? That's not material. But you'll notice that I'm being a little bit cynical here. I'm a little bit wary here. There's an important word that's listed here that's not present, or that's a little bit more relevant, and it says overstatement of income by 1.5 million. Those words are really important. And why? The reason why is if we think about what would happen if we took that $1.5 million overstatement away, what happens to their income? Becomes a loss. Okay. That was one of those qualitative factors that we said was really concerning about materiality. So even though this is not a material difference, even though this is not a material amount, the fact that it could change income from a profit to a loss may make us stop and say, yeah, you're going to have to book an adjusting entry here, simply because it misrepresents the financial position of the company, not in a material manner, but in an interpretive material manner, because people would say you're profitable when you're not. In fact, you're actually in a loss position by about 1.4 million. All right. That's the unfortunate truth here. We have to be very, very careful when we see really, really low numbers that close to just being profitable, because those could actually transition from being profits to loss very quickly. All right. Last question in this area. Emma's Designs is a for-profit clothing manufacturer. The components of the financial statements are listed there. All right. So what do you guys think? We okay with pre-tax income on this one? This one looks pretty fine. Pre-tax income, we say pre-tax income of 5%. Let's just go ahead and do some math real quick. I think that's probably going to be a reasonable amount. Oops, not 3.3,500,000. Suddenly blanked. There we go. $175,000, okay? Which is not nearly as much as we've been looking at before, but then we're not dealing with this larger company. This is a much smaller company than we've dealt with in the previous situations, okay? So 175,000, it's not a lot, but it's something to concern ourselves about. But let's move forward. What is our maximum tolerable statement in this scenario? If I use 0.5, so multiply it times 0.5, $87,500 is my maximum tolerable misstatement. It's the maximum that I can accept in any single account. All right. So during the course of the audit, MSCPA firm detected one misstatement in a key customer's accounts receivable equal to $90,000. So first question, are the financial statements as a whole materially misstated? Answer is no, okay. So there's a second misstatement in cash, but we need to focus on this. So $100,000 in misstatements. Our materiality is 175,000. So as a whole, our financial statements are not materially misstated, okay? But there's always a but here. We're going to have to throw the caveat in here. What did we note about tolerable misstatement, the maximum tolerable misstatement in any account? The maximum we can assign to any account is 87,500. So the maximum misstatement we accept in any account, including accounts receivable, is this. If you'll notice, the misstatement of accounts receivable exceeds this amount. So even though the financial statements as a whole are not materially misstated, we as auditors would look at this account and say, look, not only is this misstated, but it's a key account. It's a really important one relevant for your business operations. You are going to have to make an adjusting entry to this account because it is materially misstated. The account itself is, even if the financial statements as a whole are not. By the way, when you get to adjusting entries like this is what you get. This is where you get clients who grumble a lot. Like saying, well, we didn't exceed materiality. But yeah, we do have to be a little bit diligent with respect to our assignment of materiality and make sure that it meets all criteria and not just one. All right. And with that, we're moving on. Higher and further. All right. So this one is one that is kind of interesting, and it's going to cover some things that are not necessarily as relevant to what we're going to be talking about now, but I think it's an interesting topic to discuss. I think it's an interesting case to look at. All right. So we got Forest Crest Woolen Mills is a closely held North Carolina company that has existed since 1920, manufactures high quality woolen cloth for men's and women's outerwear, and we've audited it for 15 years. Now, 5 years ago, they signed a consent decree. All right. By the way, what's a consent decree? Consent decree is basically, oh, sorry, go ahead.
I was just gonna say, it's like a thing that you saying that says that you're not guilty, but you're coming to an agreement with the judge or whatever.
Very good. Tyler, you were the first person who have asked that question that's been able to answer that question. So well done. I've asked this question now for like 5 semesters, and everybody's kind of like saying, they're just words, Dr. Barnes, just words. So yeah, consent decree. I mean, this is one of those things that I say, if you see a term in any class and you're just kind of like looking for it, it's like, okay, I'm going to Google that. I Google a lot, by the way, because there's a lot of words, terms that I don't know. But yeah, Tyler kind of nailed it. So basically it's a settlement where there's no fault or no guilt assigned parties as long as the terms of the decree are met. So company had been convicted of dumping pollutants in the local river. The consent decree provided that Forest Crest construct a water treatment facility within 8 years. Okay. So you're conducting the current year audit, and you notice that there's been virtually no activity in the water treatment facility construction account. Discussion with the controller produces the following comment. Because of increased competition and lower sales volume, our cash flow has decreased below normal levels. You had better talk to the president about the treatment of the facility. So basically, they're not making any progress on this consent decree. All right. President says, given the current cash flow levels, we had 2 choices: lay off people or stop working in the facility. Sapporo rural North Carolina with few other job opportunities for our people. I decided to stop working in the water treatment facility. I don't think the state will fine or close us down Yes, the president of the company will be able to comply with the consent decree in forms that are uncertain. All right. So we are 5 years in and they've got what, 8 years for this? What is your conclusion as auditor here? Are you a little bit nervous in this situation? I would be. I'd be kind of like, all right, 5 years in, we should have basically 5/8 of the work probably done by this point, given the mathematical timeline. They've got 8 years to control us, and there's been virtually no progress in this area. Now, the president's explanation, it does make sense, but does it matter? So think about this way. He's concerned about the company not being able to be solvent if they lay off people in the current time and being situational in that situation, in the circumstance. What's going to happen at the end of year 8? They're going to be shut down no matter what their circumstance is, because they're going to say, look, you had a requirement to meet the terms of this consent decree. You did not meet your obligation. You're no longer in business. So we're talking about a possible scenario where if they try to meet the terms of the consent decree, they're going to be in financial difficulty, which I admit is certainly a concern. But 100% financial difficulty if they reach year 8 and not made any progress, because there's not going to be any revenues or any business going on in the future. All right. So you're concerned about this in audit. Now, let's think about this rationally speaking. Is it possible they could achieve their objective within the next 3 years? So it's certainly possible they could come around and they could say, so we as auditors would probably say, look, we need to see realistic progress within the next 3 years. I know that you're under duress. I know that the scenario is problematic, but you have to actually move forward on this because you won't stay in business if you don't do this. All right. So you got 3 years to show palpable progress. At this point, this would probably be a disclosure saying that we need to see progress. I don't know if this would be a disclosure that would be required in the financial statements, but this would be something that I'd be concerned about. That being said, that was not the only part of the question. There was another part of the question that said, would your answer change if these events occurred in 7th year after the signing of the consent decree? What do you guys think? We're now in year 7. They've got 1 year to meet the terms of the consent decree, and the president's saying, yeah, I don't think we're going to do anything. What do you guys think in that scenario? Yeah, I'm a little bit panicked in that scenario. I'm just kind of like, yeah, you guys are in trouble. Now, this is an interesting question, and we're going to talk a lot more about this. We don't need to worry about it now, but we will talk a lot more about this before the second exam, okay? Does the operations here in place reflect on their ability to report their financial position accurately? No, it doesn't, okay? We're talking about an operational concern, something that Dr. Otero would look at and say, I understand this, okay? But it doesn't have to do with reporting. This does not have to do with anything reporting, other than the fact that they should be reporting cost associated with meeting this objective. That being said, they've already said that we're not meeting this objective. We're not doing anything in this area. Our reports are accurate, okay? So from an audit perspective, we're trying to report on whether the financial statements are free from material misstatement. Is it possible that these financial statements should still be correct, yet they're not meeting their objective? Yeah, it's certainly possible, okay? So what is our role as auditors here? And the answer is that's going to be determined a little bit later. We're going to talk about something called a going concern issue. When we get to chapter 17, we'll talk about the nature of that. Have you talked about that in previous courses? Have you heard that term before, going concern? This would be an example of where the auditor has to step in and say, I believe that there's substantial doubt about your ability to continue as a going concern. Now, what is the auditor's responsibility in that? The answer is, we'll get to that here in a few weeks, maybe a little bit over a month. What is today's date? 20th, month and a half. How about we say, well, we settled month and 3 quarters. Okay, month and 3 quarters. We'll get to that in there because I forgot about spring break. But we'll talk about the nature of what substantial doubt about the entity's ability to going concern. The thing to illuminate here is that this normally would not be under the auditor's purview, but because of the nature of the business and how extreme an impact it would have if it is not met, we do have to consider that as part of our assessment. All right. Last thing to talk about, we got some materiality to go into. All right, so let's get into it. So we talked a little bit about this on Wednesday, and now I've got the solutions manual. Now I'm going to tell you, if you got the exact answers to the solutions manual, I'm about 90% sure you cheated, okay? But again, the goal here is the endeavor of going through this. And I do want to actually talk about some of the intuition that goes into this, what the thoughts are that go behind the calculations here. So the first thing we're going to do is we're going to look at their planning materiality, okay? The calculation of planning materiality. So our measurement base is pre-tax income. Now, there was some concern about whether or not pre-tax income should be used. And there was concerns about volatility. So in order to be able to use this as a basis, we don't want pre-tax income to be volatile. And there was concerns about whether that's the case, because we go to the income statement, you will notice that pre-tax income before income taxes, was double what it was in the previous year. I'm going to zoom in so we can actually see this. Current period, it's $70 million. Previous period, it was about $36 million. Now, the question is that volatile? In your opinion, is that volatile? So in our opinion, we can have different opinions. Some people say yes, no. So some people say it's Friday, Dr. Barnes. Come on. All right. But one of the answers is going to have to be whether or not it's volatile. Do we have guidelines that I can actually provide interpretation for that? Now, that's the interesting question. The answer is, do you have materiality guidelines? And your answer should be yes, Dr. Barnes. I read them thoroughly and diligently. So in the materiality guidelines, what does it say about volatility? It says that volatility represents moving from a positive position or a negative position to a positive position consistently. Okay. So we go from profit to loss and back and forth. Is that what's happening here with Earthware's income? It's not. It is not volatile. Therefore, pre-tax income can be used as a measurement base. That was a lot of explanation for just coming up with that arbitrary conclusion, right? Isn't it? Now, here's an interesting one. Percentage applied, they have 4.5%. Now, how many people use 5% here? And we're pretty happy with their numbers. As you should, okay? 5% is completely reasonable. I'm not going to say that you're wrong if you used 5%, okay? 5% is perfectly fine. Why do you think that they said 4.5% here? So as we're going to talk about a little bit later in the course, we're going to be talking about comparability between periods, comparability between periods. One of the things that we're concerned about is whether or not information that we conducted in one period of an audit can be comparable to previous periods. Now, if I used 5%, that's going to be basically 3.5 million is what you came up with. If I compare that to 5% of pre-tax income from the previous year, that's actually half of that. Because remember, pre-tax income was half of what it was in previous year. So materiality is not necessarily comparable to what it was in previous periods. So the argument here that they make is they say, we made this slightly smaller just to make this more consistent with what we did in previous years. Now, you may be arguing, says that's nonsense, Dr. Barnes, and you're absolutely right. It can be construed as nonsense, all right? This is not a correct quote unquote answer. This is a judgment call about what to use 4.5%. And this is a judgment that they used in using that number. You would encounter a lot of these in the real world about adjustments that say, well, I don't understand it. And they said, okay, I guess that makes sense. That's the conclusion you should reach. It's like, Dr. Barnes, I guess that makes sense. And if you're with me on that so far, that's all I was really angling for. But let's get down to the tolerable statement. So tolerable statement is going to be 75% of that, so that's the maximum amount we can assign. And so we go start assigning amounts in tolerable statement here. So let's actually talk about the accounts that you had to assign to. Cash and cash equivalents. We have already talked about that. All right. What do we say for cash and cash equivalents? How difficult is it to audit? Not difficult at all. It's a very easy account to audit. So we can set that number very low. We do not expect to have misstatements in this area. Now, the interesting one comes up with receivables. And you'll notice receivables has a fairly small amount, 700,000. In a traditional business-to-business environment, would you expect the receivables to be a major account for most organizations? Yeah, in the situations that you probably looked at in your financial accounting courses, you probably said, you know what, accounts receivable is really an area of hot operations. Do we think that there's a lot of accounts receivable in this particular business environment? Now, before you answer, think about the nature of the operations. Who are they selling to? Are they selling to other businesses? Or are they selling directly to customers? Really directly to customers. So a business to customer environment, do those generate lots of receivables? Because receivables are usually for business to business situations where you generate a lot of invoices in a period and customers want to pay off all their invoices at once. If you're generating to customers, they pay off immediately when they buy. And I know you may say, well, I buy on credit, Dr. Barnes. You've got a credit card. So who's paying for that? Are you paying for that directly, or is your credit card going to pay for that and you're going to pay the credit card back? Yeah. So if you pay it on credit card, it doesn't matter to Earthware Clothiers. They're still getting cash for that payment. It's a credit card transaction, but they're going to receive the payment immediately. This is not a transaction on credit. So it looks like their receivables are small, and they necessarily should be because of the nature of the organization. So we can actually say that here. And so receivables are going to be minimal in testing because they're not a large account. It actually looks like they had a smaller account receivables balance from previous years. Does that represent greater risk or more risk when you see a smaller receivable balance? Or greater risk or more risk, gracious. Greater risk or lesser risk? Less risk, okay? Why? They're collecting their receivables in a more timely manner is what it looks like, okay? I would rather have a much smaller receivables balance than a much larger receivables balance because I want to make sure they're collecting those. If you can't convert receivables to cash, you can't stay in business. All right. Then we have prepaid expenses. We're going to find out a lot about this much later in the course, but prepaid expenses are very easy, okay? Remember, what was one of the very first things you learned back in accrual-based accounting back in 220? You learned how to calculate those prepaid expenses and how to allocate those. Not much more difficult than that. I know it seemed difficult at the time, but it's very easy for everybody now. So very small amount here. Accumulated depreciation and amortization. All right. We actually have a large account here, a pretty high amount here, but I will say that this is generally going to be pretty easy to audit. Okay. As we start talking about evidence collection, we're going to talk about something called an analytical procedure. And basically what that's fancy term for is identifying easier ways to perform testing on accounts. Now, for this particular account, let's talk about something that you may not have thought about before. If I asked you to calculate depreciation expense for a client, could you do that? Another way to ask this, has anybody ever calculated depreciation before? I hope so. Okay. Hope that is something that you did multiple times in your financial accounting class. So if I told you the client's assets, like the different useful lives of their assets, the values of those assets, and the methods that they use for depreciation, do you think you could come up with a pretty good estimate for that? Yes, and that's all I'm asking here is that this is not difficult to audit because you can actually develop a pretty good estimate on your own. If the estimate was not close, that's when you panic and you'd say, I don't know why this is so far off. Something is not right. But we'll see more of that as we move forward. Intangibles we talked a little bit about. It's a small account, but it does have some risk for it. Accounts payable. Now, here's an interesting one. We are a business to customer environment, which means we don't have a lot of receivables. But is this going to be a prominent account for the client, the accounts payable? Just compare receivables to just receivables to payable. Their accounts receivables were 8.6 million. Their payables were 60 million. So it sure looks like that they generate a lot more payables, and it makes sense because they're buying from wholesalers who create these goods that they sell for retail. So they generate a lot more payables than they do receivables. What do you guys think about the nature of that account? Is it going to be a much more important account for them to audit or for us to audit in this kind of context? There's going to be more risk associated with payables. There's probably a lot more transactions, a lot more risk associated with those transactions, a little bit of concern there. So this is 1.9 million. This is pretty close to our tolerable misstatement threshold. Pretty close, not quite there. Accrued liabilities and profit sharing. So guys, do you guys feel comfortable with accrued liabilities? You did a lot of that back in financial accounting. Say, oh yeah, I can accrue a liability. Everybody. Accrued liabilities are really, really weird. They come up in really weird scenarios. So they're kind of challenging to audit. They do require a little bit more testing. The good news is this is not a particularly large account. It is somewhat large, but not a large account, so we can actually make it smaller. Then income tax is payable. Okay, I like the explanation here. It's not difficult. Payments to compute, but underlying calculations are complex because that's the nature of tax. It's just innately complex. Okay. Ultimately, what you're trying to do is you're trying to come a justification for assignment here. And what we were trying to do for every account is make it as large as possible without going over that 4 times threshold. So if you did that, you will notice that the total amount that you're trying to get to is about 12.5 million, because that's roughly 3 times that. Now, you could use a larger amount if you used 5%, because this was actually 3.5 million if you used 5% rather than 4. But your goal should be right here to get to 4 or to get close to 4. If your number was much smaller than 4, is that a problem? Absolutely a problem, okay? Let's think about what's happening here if that's the case, okay? If I assign these numbers way too high, if I make this number like a 7, basically I'm allowing misstatements that should not be allowed, okay? I'm making these accounts so large that they could have material misstatements. So that's why I limit this number to 4 times planning materiality. What if I make this number smaller? Like, what if I make these numbers so I say, all right, instead of 400,000, I'm going to say 20 or 400 million, 400,000. So 400,000, I'm going to say 20,000. This is 700,000. I'm going to say 100,000. Okay, and I'll make these numbers all smaller. Okay, so you'll notice here, this number down here is getting smaller. It's much smaller than 4. Okay, good thing, right? What are the auditors going to say to you after you bust that plan? They're going to say very rude things that I can't repeat on camera. Okay. They're going to say, you have made it so we have to do so much more work in these accounts because our materiality thresholds are so small. We have to test for really, really small, minute differences. So the goal here is to make these numbers as large as possible without going over that 4-point threshold. And that's what we did here. Now your numbers are going to look different than mine. Okay. Like I said, unless you had the solutions manual, which if you did, good being innovative for you, I guess. Okay. But the importance here is not making sure your numbers are correct. There is no correct answer here. The goal here is to make sure that you can use judgment and assignment of numbers, and it's consistent with the expectations that I've set forth before you. All right. Any questions on that? All right. Well, hopefully that even if it wasn't there wasn't perfect clarity on there, that you found some interest in the experience and learned a little bit about that. So we are starting chapter 4 on Monday. Have a good weekend.